Ladies and gentlemen, good day and welcome to Q4 and FY23 earnings conference call of Nazara Technologies Limited, hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Kumar from JM Financial. Thank you, and over to you, sir.
Thank you, Yashashree. Good morning, everyone. Welcome to this call of Nazara Technologies to discuss fourth quarter and full year FY23 results. We have with us the management team of Nazara, represented by Mr. Nitish Mittal Sen, CEO and Managing Director, Mr. Sudhir Kamath, Chief Operating Officer, Mr. Rakesh Shah, Group Chief Financial Officer, and Ms. Anupriya Sinha Das, Head of Corporate Development. With that, let me now hand over the call over to Mr. Nitish Mittal Sen for his opening remarks. Thank you, and over to you, Nitish.
Good morning and a very warm welcome to all of you to Nazara Technologies Limited Q4 and FY23 earnings call. We have uploaded our results presentation on the exchanges, and I hope you have had the opportunity to go through the same. We are delighted to report another milestone year for Nazara. We have delivered a strong performance in FY23 with revenues surpassing the 1,000 crore INR mark for the first time at INR 1,091 crores, and our EBITDA coming in at INR 109.7 crores. Revenue growth was at 75.5% year on year, with an overall EBITDA of 10.1% and year-on-year 21% PAT growth. A healthy year-on-year revenue growth across all business verticals, including gaming, esports, and AdTech, demonstrates our commitment to drive growth aggressively alongside profitability while prioritizing growth so that we can achieve scale and market leadership in the spaces we operate in. In terms of our performance for the quarter gone by, our revenue grew by 65% year-on-year to INR 289.3 crores. EBITDA grew by 86% to INR 27.7 crores, and the PAT increased by 92% year-on-year to INR 9.4 crores. The company is currently operating in three key segments, which are gaming, esports, and AdTech. Our gaming segment comprising of sub-segments, namely gamified early learning, premium, RMG, and telco distribution, generated a total of INR 406.3 crores, which was up 28% year-on-year and delivered an EBITDA margin of 17.5%. Our esports business generated INR 531.5 crores in revenue, up 74.9% with a 7.8% margin. And our AdTech business generated 153.2 crores in revenue with an 8.8% margin. Through our acquire and scale model, we continue to address pre-identified white spaces in our existing business segments via strategic acquisitions, while being focused on profitable and sustainable organic growth of our existing businesses. Our existing businesses are generating cash, which is being redeployed first to drive organic growth and thereafter for acquisitions, as can be seen in the recent Sportskeeda and Pro Football Network deal. This operating model enables us to create a flywheel that keeps gaining momentum across stable, growing, and diversified cash flow generating businesses in the spaces we operate. On the M&A side, we will continue to expand our presence in gaming, esports, and AdTech. The current market environment provides us with several attractive opportunities, and we are continuing to work actively towards the same. Lastly, on the skill-based real money gaming space, the emerging regulatory clarity is a huge positive for our industry. The Ministry of IT has recently issued a framework for operating skill-based RMG, and clarity on online gaming TDS that was provided in the budget and thereafter has also been helpful. While clarity on GST is yet to emerge, we are hopeful that this will get resolved in the coming months. Since currently skill-based RMG is only 5% of our total revenues, it provides a significant scale-up opportunity for us going forward. And with regulatory clarity emerging, we are working on a three-pronged approach towards the same. Through growth in our existing games, launching and publishing new RMG games, and acquiring existing RMG companies to drive scale for ourselves in this sector. I would now like to hand over the call to Anupriya to give some highlights on our specific business segments. Over to you, Anupriya.
Thank you, Nitish. Good morning, everyone. As you're aware, Nazara operates across three segments: gaming, esports, and AdTech. Gaming includes gamified early learning, real money gaming, freemium, and telco distribution sub-segments. This segment grew by 28%, contributing to 37% in revenues and 56% in EBITDA in FY23. Our playbook here is to invest in user acquisition backed by unit economics while focusing on product and content updates to drive retention metrics. All our key IPs continue to see growth. If you look at Kidopia, which is a flagship IP within gamified early learning segment, we continue to see subscriber growth in Q4 FY23 despite negative impact of seasonality. As we know, Q3 is the festive season in the US and Q4 typically sees a pullback. But in spite of that, we have seen a growth in the subscribers for Kidopia. The subscriber number increased to 311,758 in March 2023. Kidopia continues to be the number 2 grossing app for kids under 5 years in the US. EBITDA margin for the business improved to 18.4% in Q4 FY23 versus 11.6% in Q3 FY23, driven by cost per trial reduction to $35.9 in Q4 from $37.3 in Q3. Moving on to Animal Jam, which is another IP in our gamified early learning segment. We are setting the platform for growth and retention. The team has worked on improving the analytics backend to get actionable product and user acquisition insights. On the product side, we have improved the cadence of content updates to drive growth. We are leveraging group capabilities for user acquisition via DataWorks. The emphasis on optimization on a non-core cost has led to an improvement in EBITDA margin from 3% in Q3 to 11.6% in Q4 FY23, and we expect this upward trajectory to continue. Moving to WCC, World Cricket Championship, we have significantly improved monetization of users, leading to 38% growth in ad revenue, 26% growth in overall revenue, and improvement in EBITDA margin from 19.1% in FY22 to 26.2% in FY23. We have also announced that we are acquiring an additional 19.5% stake in Nextwave Multimedia, the holding company for WCC, and this transaction is expected to be completed in the next few days. OpenPlay, which is Nazara's initial step into RMG space, we've seen a revenue growth of 33% year-on-year in FY23 and EBITDA growth of 79% year-on-year due to better cost optimization. We wheeled out players that were not generating revenue but consuming bonus. We are further improving the acquisition funnel, branding, and player journey. Tamil Nadu banned online games with chance of money, including rummy and poker, in April 2023. Tamil Nadu contributed to 20% of our revenue and hence the ban will have a short-term negative impact on the business. However, we are trying to actively mitigate this downside risk. As Nitish mentioned, with new regulatory clarity emerging for the RMG segment, we are working on a larger blueprint for Nazara in the RMG space while using organic and inorganic levers. Moving to our esports segment, which contributes to 49% of our total revenue. This segment grew by 75% in FY23. So specifically of Nodwin, the revenue grew by 84% in FY23, driven by growth in multiple IPs. The IPs that have seen a strong growth are Playground, PUBG in South Asia, and Digital, as well as a strong growth in Wings, our gaming accessories business. Operating leverage will kick in with scale. So we will see a non-linear growth in EBITDA to come from own IPs and media rights. Accessories business to become margin accretive as brands get more strongly established. Nodwin has acquired 51% in Branded PT Limited for a cash consideration of $1.3 million. Singapore-based Branded PT has built marquee IPs, including All That Matters, It's a Girl Thing, and Creator World. This acquisition will also drive sponsorship revenue for all of Nodwin's IP in India and internationally. Sportskeeda revenues grew by 55% in FY23 as US revenues grew by 89%. 104% growth in revenue from esports in FY23 for Sportskeeda. Direct brand sales now contribute to 26.7 crores in FY23, which is more than double of the corresponding number in FY22. Sportskeeda acquired 73% stake in Pro Football Network, a premier source of coverage and analysis of NFL in the US in March 23 for $1.82 million. With more than 5 million MAUs, PFN is ranked third amongst the top NFL-focused media websites in the US as per SimilarWeb rankings in January 2023. AdTech, our newest growth engine, also performed well and grew by 53% year-on-year in FY23. This segment contributed to 14% of revenues and 11% of EBITDA in FY23. DataWorks added 42 new clients in FY23, contributing to 34% of total revenues in the same period. The company lost one significant client, however, there will be a minimal EBITDA impact due to growth in new clients. DataWorks continues to build all three of its business units: IPD, which is the services for advertisers; MediaWorks, which is the services for publishers; and Visible, a self-serve demand-side platform. The company is ramping up sales capabilities globally and is also actively evaluating M&A. All our business segments continue to be cash generating. We closed the year with 628.3 crores of cash in our balance. Our strong cash position not only provides financial strength for organic growth, but also allows us to deploy capital for strategic M&A. I'll close my remarks here and would like to open the call for Q&A. I would request Nitesh, Sudhir and Rakesh to join me for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Thanks for the opportunity. I have a question on the EdTech business, which seems to have reported a loss in this quarter. So can you highlight the reason behind it? Has it got to do with the loss of clients which we just highlighted? And if yes, what is the reason behind it? And how much did that client contribute to our business? And by when do you expect the business to stabilize from here on? That is question 1. And just a follow-up on that is, this time around, we have not disclosed the EBITDA of EdTech and telco businesses. If you can just share that as well.
Jinesh, this is Nitesh. I didn't hear your question. Can you repeat that, please?
So the EdTech business seems to have reported a loss in this quarter. So the question is, has it got to do with the loss of clients which we just highlighted? If yes, what was the reason behind that loss, and when do we expect the business to stabilize as such?
Sure. And the second question also?
The EBITDA figures for EdTech and telco business, which we have not given in the PPT this time around. So if you can share those numbers.
Sure. Okay. So just to clarify, the DataWorks, the AdTech business has not posted a loss. It is revenue of 39 crores in Q4 with 2.7 crores of EBITDA. So it's profitable. It's posted 6.9% EBITDA in Q4 and total EBITDA of 13.5 crores for the year on revenues of 153.3 crores. The total EBITDA being 8.8%. So business continues to be profitable. We mentioned the client that was contributing revenues, for the low margin client. So we don't expect any, large impact on our EBITDA. And we expect that we will continue to do well in the coming FY24. We've been actually adding a lot of new clients. We've also appointed some sales teams in the US. So we are actually on a pretty aggressive growth path over there and feeling very confident about the business. On the telco business, we had 52.8 crores of revenue with 13.9 crores of EBITDA, which was a 26.3% margin.
Sure, sir. Actually, I was looking at the EBIT number, which was negative, and hence the confusion. Thanks for the clarification. Sir, my second question is on Nodwin. So if I look at the content views that we have shared in the PPT that have gone up in FY23, even the distribution hours are up when I compare it with the last financial year. Yet the contribution of media rights revenue has come down from about 39% odd to about 21% in this financial year. So does it mean that pricing has taken a hit over here? If not, can you explain the reason behind it? And also, if you can share, I mean, what kind of EBITDA margin can we make on mature IPs solely from media rights licensing? Because apparently it appears to be a high margin business for us. So just wanted your thoughts on that.
Sure. So on the media rights revenue, right, I think for the FY23, while our percentage contribution has dropped, from our absolute terms, the revenues have been broadly flat for us. And one of the large contributors for that reason is that, because of a lot of the popular games got banned, some of the media deals we had in place kind of dropped off, which would have generated, the significant growth in media revenue. So I think despite the games being banned, us being able to also maintain the media rights where they were was a good performance. And we expect in the coming year that to normalize. So that's one aspect. I think for an established IP with media rights, we should be able to get to, in the near term, right, about 20-25% kind of EBITDA margins once there is stability on the games, the popular esports titles. I hope that answers your question.
Yes, sir. One last question from my side. The PFN business that we acquired recently apparently seems to be marginally loss-making at the operating level in CY22. So just wanted to know what can be the steady-state EBITDA margin in this business, and by when do you expect to achieve that?
Dinesh, sorry, which business?
The Pro Football Network business that Sportskeeda acquired, the PFN business.
Yeah, no, I think that's a fantastic plugin for Sportskeeda. It's a top 3 destination in the US, and it deepens Sportskeeda's vertical in that space. The team there is fantastic, and even its early days, we're already seeing some very strong growth in KPIs. So we are very confident of delivering good profits and good EBITDA on that business in the current year. We think the synergies between Sportskeeda and PFN will play out very well, and we should start seeing that from as early as this next quarter.
Would you like to share an indicative steady-state EBITDA margin number over here?
It's very early, Dinesh, so I'd like not to do that.
Sure, sir. Thank you so much and all the best.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Abhishek Banerjee from ICICI Securities. Please go ahead.
Hi. Just a couple of questions. Firstly, on the cost per trial in Kiddopia.
Sir, I'm sorry. Can you use your handset mode, please?
Hello?
Yes.
Is it fairer?
Yes.
Yeah. So, first of all, great set of numbers. Just a couple of questions. First, on Kiddopia, the CPT decline of close to $1.4. If you would give us some, clarity on how that happened, and what is your outlook going forward? So, could we see another, a dollar kind of decline in that CPT, which would have, very, very big impact on your margins going forward, or is it likely to stabilize at this level?
Yeah, I think the team has been working hard on getting the right optimum mix of cost per trial, and the volumes that we are able to spend and acquire users. And I think Q4, because Q3 usually is the October to December Christmas season in the US, and it's, a peak season. Q4 usually is a bit slower, and I think we focused on optimizing our CPT in this period. You can see the result in front of you. I think there have been a lot of things we have done in the Kiddopia business in the last few months, which includes the price increases. It includes, trying to start scaling up the volumes again. We've kind of overcome that IDFA issue, gone back to spending a lot on Google, which we had earlier stopped. So I think this quarter has been for us to stabilize the business, just check out all our key metrics healthy and stable, which we are finding they are. And I think the way to look at it is the CPT range will still remain between this $35 to $37. Now our focus going forward is going to be how can we also parallelly start scaling up some of the spend volumes to start increasing the subscriber base. You can see in Q4 our EBITDA margins actually improved quite significantly, 18.4%, versus successive quarter of 11.6%. So I think we're on the right track with Kiddopia, stabilizing the business and getting it back to growth track.
Got it. So, but on one hand, you're saying that you stabilized the Kiddopia business and CPTs came down, and even in a lean season, you managed to grow subscribers. So, is there some tailwind which is happening in the sector? Are people coming into the segment?
No, I think Kiddopia business itself is the Kiddopia app, right, is quite a loved app, continues to be very popular, and the team continues to work very hard on the product side. As you might have seen, even Tim Cook, the CEO of Apple, recently came to India and met the Kiddopia team and also tweeted about how Kiddopia is impacting positively to kids all over the world. So that's a big validation of the product, and I think that's what's helping us, I would say, outperform competition.
Understood. Also, in terms of the acquisition pipeline going forward, so you have been very active in this space, right? But at some time, management bandwidth becomes a constraint, to support such a wide portfolio. So, would you give us some clarity on what kind of acquisitions you will try to do in the next year?
Yeah. I think the flywheel we have, right, is a distributed flywheel. So what I mean is that, let's take Sportskeeda, for example. Nazara went and acquired Sportskeeda 3.5 years back and grew it from, let's say, a 15 crores revenue to, this year's, I think we've done, one second. We have Sportskeeda 122 crores revenue, right, with a 39 crores EBITDA this year. 3.5 years back when we acquired the business, it had a zero EBITDA. So this company has accumulated cash over the last 2 years, generating profits, and we built a strong management team there. We have a CEO in place, we have a chief strategy officer in place who's very focused on M&A. And through our experience, we've kind of, guided these teams. And the Pro Football Network is an acquisition done by Sportskeeda and is being completely managed by the Sportskeeda team under our guidance. So what this structure allows us is to continue doing this M&A activity without it sucking up a lot of our operational bandwidth at Nazara level. So while Nazara may be selective in doing acquisitions, you may see bolt-on acquisitions happen at a more rapid pace at the companies below because they are generating cash, accumulating cash, and it's a great deployment of their cash to further their businesses. That's where we kind of bring in our experience and expertise in doing these transactions. But the actual operations of these M&As are done by the teams, of the subsidiaries. I think that's working very well for us. At the Nazara level, I think our thought process going forward is that we will be taking fewer and larger bets on M&A, whereas bolt-on acquisitions will largely happen at a subsidiary level.
Understood. And if you're talking about larger acquisitions, does that mean taking on some leverage?
Sorry, can you repeat that?
So, if you're talking about larger acquisitions, does that mean taking on some debt?
At this point of time, we've not, looked at it, but I would say that from zero debt to moving to a low debt could be an option, but largely any debt, if we were to take it, would be purely against the cash flows of the target company and not backstop the Nazara.
Understood. That is very clear. Thank you so much, sir, for your time.
Thank you. We have our next question from the line of Abhishek Bhandari from Nomura. Please go ahead.
Thank you for the opportunity. Nitish, I had one question. If I go to your slide number 32, I'm just trying to reconcile, the slowdown of EBITDA into operating cash flow. While we have generated 100 plus crore of EBITDA in FY23, the net cash flow from operations is just around 8. Part of it is explained because of, working capital. But if you could, elaborate, how are you thinking to, bridge the gap between the two? Or is it a nature of the business that this kind of gap will always exist?
No, I think this year we've seen a slight increase in working capital in many of our businesses. And I think also there's some, for example, in the case of Kiddopia, right, because we had an SVB issue, we kind of advanced significant amounts of money to places like Google where we advertise to kind of secure those funds. So I think it also got skewed because of that. I think we should continue generating good cash. In FY24, we expect to generate good cash. I think the other place our working capital got stuck or got sucked in is the gaming accessories business in Wing, which is a working capital intensive business. So we are working closely with the team on how can we create better cash flow management so that working capital doesn't get sucked in there continuously.
Got it. So is it fair to say that the steady state EBITDA to operating cash flow conversion would settle at a higher rate? Like, would it be like 40-50% of your EBITDA?
Absolutely.
Got it. Thanks, Nitish, and all the best.
Yeah.
Thank you. We have our next question from the line of Deep Shah from B&K Securities. Please go ahead.
Hey, good morning, sir. Thanks for the opportunity. So the first question was around some qualitative commentary on the Valorant Challengers Tour. The context is last year we had a deal with Star Sports thanks to BGMI, and I hear you alluded that some media deals have lapsed because of games being banned. So any rough metrics you can call out as to what is the engagement levels for Valorant, and that can give us some guidance on when those media deals come back? Because if I understand correctly, more than the monetization, it is the reach which would have been large with Star Sports as a partner. So that's my first question.
So I'll just answer that first. So the BGMI on Star Sports, was the first program we ran with Star Sports, and that was extremely successful. We had great response, and Star Sports was very excited about season 2 of Sing. However, because of the BGMI ban, we could not kind of continue with that, and that was also one of the reasons our media revenues kind of dropped or didn't grow as we expected in the previous year, FY23. Valorant is early days. The league has just launched and we will be building up. Valorant versus BGMI, the difference is that Valorant is a PC game with a slightly smaller community compared to BGMI. It's a more intense community, but from a visibility point of view, viewership point of view, it's a bit smaller. So we are kind of building it out before we take it, with a large channel. The other media content that has done well for us is the Playground series. Season 1, got about 17 million viewers. Season 2 got about 40 million viewers. We have Season 3 launching in June, and that which is actually changing the format a bit and going to run a year-long season. So I think that should also be very positive for us.
Right, Sandesh. So second question, so I hear in your opening remarks, and correct me if I'm wrong, but I hear that operating leverage has started playing out in the esports vertical this year. But I was rather thinking that profitability would be protracted given that we have a lot more new IPs, a lot more marketing required. given that, as you rightly said, Valorant is a different game than BGMI. So how should we think about this profitability piece? Will it be protracted, or we'll see a lot of players start flowing right from FY24? And as a parallel question, what is the plan for new IPs? Anything which you can help us understand?
Sure. So I think just to summarize, if I understood your question, you're asking about the esports margins in FY24?
Yes. So should we see a pickup right in FY24, or will it take some time? And second, on the new IPs, or where do you see scaling up of existing IPs that we have?
Yeah.
Any your thoughts on what the blue sky there would be very helpful.
Yeah. So I think in terms of margins, we are still projecting specifically for Northern Gaming. We are not in FY24 projecting large, very large enhancements in EBITDA. We will try and optimize where possible, but our focus is going to continue to drive strategic growth in that business. I think in terms of your second question about IPs, right? Valorant is one that Northern has already launched. They launched a chess league, which is also doing very well. There are 2 or 3 different leagues that Northern is currently in the midst of launching or has launched, which we think will build strong IP. There is a Kingfisher India Premiership 23, which has been announced. This is having games like Tekken 7 and Clash of Clans. There's a PUBG New State Pro Series Challenger Final, which was done. I think there's a lot of IPs work in progress, working with major gaming publishers who want to do a larger India play. So I think there's a lot of activity happening there, and you will see that build-up happen throughout FY24.
Sure, sir. This is very helpful. Thank you so much.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Thank you. I hope I'm audible.
Yeah, hi. Mukul.
Hey, Nitish, good morning. So Nitish, just a follow-up on the Nodwin point. If you look at either the content view or the distribution between Q4 FY22 and Q4 FY23, it obviously has come off a bit. I just wanted to get your sense on how should we think about the opportunities playing out over the longer term. This quarter we were trying to do that through Valorant and ESL, but clearly the response has not been up to what BGMI or FIFA were kind of receiving in from players. So how are you kind of visualizing the longer term opportunity capture which is out there in the space? Because you have been able to grow your revenues quite smartly, but that is probably more because of broadening of offering rather than the viewership or distribution.
Yeah. No, absolutely. So I think you are bang on that in terms of the viewership, which obviously got impacted due to the games that got banned. See, we need very popular mobile gaming titles in a country like India to drive maximum viewership. And one of 2 things will happen: either the space that is currently there will get filled up by some new titles, or you will have some of the existing titles come back, which is also possible in the next few months. So I think while that happens, obviously we are working on creating many other IPs. We do see Valorant, etc., also building out. We are working closely with them and building it out. But to see a large surge, I think you need to get those large mobile esports titles on the back of which a lot more viewership can be generated.
Right. So, just to follow up on this, are there any potential names which you are seeing, which are in the pipeline, or are you in discussions with the government in terms of what the scenario in terms of these Free Fire or BGMI, which were quite popular in the country, to kind of get them back as an option?
Yeah, so no, we actively, as an important stakeholder in this whole space, right? We are obviously interacting both with government as well as the publishers to see what solutions can be found here, and we are very hopeful that some positive news will come in the coming months, right? That said, there are other games like Call of Duty Mobile, etc. that we are working with. So I think focus is on expanding the titles that we work with, as well as working closely with the publishers to see whether some important titles can be relaunched.
Yeah. And the second question was, again, for the related question. When I look at WCC performance, it obviously has been weaker than what it was same time last year. You have, on the other hand, increased your stake in Next Wave. So, any thoughts on how you are kind of visualizing your investment into the space? There's a lot of stuff which is happening on the mobile gaming side. Are you hoping to kind of aggressively expand and create an alternate opportunity here?
Yeah, so I think we are at a point where we think that WCC can be starting to scale. We've always been focused on KPIs, and I think our LTV CAC equation over there is starting to make sense. So we will hope. I think for the franchise that World Cricket Championship is in India, the kind of monetization we do today, or even the kind of user base we have, is relatively low, and there's a lot more that can be done in terms of scaling this up. So I think that's our plan for FY24, that how do we monetize this product better, and how do we, scale up the user base so that we have a multiplier effect on the overall business. We also brought in a chief operating officer recently who's joined us from a large gaming studio and is working very closely with the team to kind of action some of the things we want to implement.
Sure. So, should we expect, kind of front-ended investments to, kind of generate the required growth, or are we already seeing a tipping point and, we feel that the growth can happen while, you are still kind of getting a favorable returns on the investments?
Yeah. No, I think we don't anticipate large investment in terms of, SG&A costs, etc. But I think in the near future, we will potentially, ramp up our user acquisition on that product to scale the user base.
Got it. Thanks for answering my question, and best of luck for the quarters ahead.
Sure. Thank you.
Thank you. We have our next question from the line of Abhishek Kumar from JM Financial. Please go ahead.
Yeah, thank you for taking my question. First, I just noticed that we have not given any guidance for FY24. So just any sense on how are we looking at the overall portfolio growth, and also how should we look at margins now? Things appear to have stabilized. So any color on growth and guidance for next year? Growth and margins, sorry.
So Abhishek, we are not giving a guidance at this point of time. As you've seen, since we listed, we have usually given guidance in September once we have a better grip of the whole year. But our intent this year is to obviously, enhance margins in businesses where we can, and choose certain businesses which will continue to drive strategic growth for market leadership. So I think we'll continue following the same approach. Generally, overall sense of mind today is that there should be some margin improvement in the overall year.
Great. Now, second question is on real money gaming. A lot of regulatory clarity has emerged over the past couple of months with self-regulatory body and even on TDS. And we have also talked about a larger blueprint now in RMG. So just wanted you to flesh out, what would that mean? What would that entail, both in terms of organic and inorganic strategy?
Yeah. So, like I mentioned in my opening remarks, there are three ways we are approaching this. One is how can our existing RMG businesses, especially OpenPlay, which runs the Classic Rummy brand, grow fast and more aggressively. While Anupriya mentioned there was a short-term blip because of the TN ban, where this game is quite popular, I think that's a short-term noise for us. But we are looking at the larger picture. How can we really scale that business up? That's point number one. Point number two is we are working with many new game developers, many developers and global companies to publish RMG games in India, which are innovative and new, and scale them up. And I think with this framework, we can do it a lot more confidently. We can invest more aggressively in them, build our user base, and scale revenue. So I think that's the second thing we've been actively working in. And the third is we are in talks with various existing RMG players to see whether there is consolidation opportunity possible. So I think basis these three actions, we are looking to definitely start scaling our RMG business going forward.
Okay. Just one clarification. You said you're working with global publishers. So are we also looking at expanding beyond Rummy in RMG?
Yeah, most definitely. So just to clarify, our focus on RMG is the Indian market. But we are definitely looking at launching new games outside of Rummy as well in the Indian market, which are fresh and new and will be appealing to the consumer base here.
All right. Okay. Thank you and all the best.
Sure. Thank you.
Thank you. We have our next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My question is pertaining to the gamified business, Kiddopia and Animal Jam. I know you shared some of your thoughts earlier, but I think from a real growth addition point of view, I think this segment would play an important part in this year. So if you could share beyond what you just shared in terms of the stability and eventual progress. So how you see the demand based on the revised pricing and the churn behavior? And when you think what is the data point that you would watch out for before you kind of speed up the pedal to drive your marketing spend here to drive growth? And how the revival on the cost side and in terms of content side shaping up in Animal Jam, and what kind of growth one should envisage over the next 4 to 6 quarters there?
Sure. So on Kiddopia, one thing we've done is launched a lot of new content and features which are quite appealing to the consumers, both parents and kids. For example, the coding for kids which has been launched in Kiddopia has been very well appreciated. And I think parents are willing to spend the extra money that we have increased prices, right, from 7.99 to 9.99 without hesitating. And that reflects in our KPIs like churn, which is, if you see the last 4 quarters or 5 quarters that we have shown in this, is pretty constant, irrespective of the price increase. I think that is the good news. That and the way that's going to help is, with our cost per trial in control and the price increase, our margins in FY24 are going to look much healthier than what they were in FY23. Because LTV CAC ratio has improved significantly. So I think that's one aspect. Now what we are basically seeing is, while keeping our cost of trial, let's say between $35 to $37, how can we increase the spend from $1 million a month to significantly more? What we don't want to do is again break the cost per trial range that we have established. So we don't want to take it to $40 plus. So we kept a guardrail there, and the team is working actively on various channels to see how we can start increasing spends within this guardrail of cost per trial, so that our margins are also protected. Coming on to Animal Jam, I think we are very excited with what we've seen in the last few months after the acquisition. We spent a lot of time getting our grip on data. I think the data is very interesting and is showing some healthy results already. In Q4, if you see, we've also worked a lot on optimizing various costs that were built into the business. So if you see Q4FY23, we've seen a growth in EBITDA margins to 11.6%. And we think we should get this business very quickly to about a 20% EBITDA margin and grow it from there. A lot of product work is happening on features that can help monetization better. But one of the challenges with Animal Jam we found was that the conversion to monetization was fairly low because the features that were implemented did not make the people play. 95% of the game was being played for free, and I think we are tweaking some of those things which will help us improve conversions and scale the revenues. So very excited about Animal Jam as well. It's a very strong IP within the consumer base, and I think in gaming, as long as you are owning good IPs, there's a lot more you can do with it. So Kiddopia and Animal Jam are strong IPs in this sector, and there's a lot more we can do with them going forward.
Does that answer your question, Mr. Jain? Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have our next question from the line of Mohana Kumar, an individual investor. Please go ahead.
Congrats on a great set of numbers, and it's been a pretty solid last couple of years. So I just wanted to get some qualitative understanding of what the growth could look like over the next year. I understand that it's still very early, and you probably are comfortable providing numbers towards the second half of the year. But do you feel that the growth trend that we have seen can actually continue to grow organically? If not at the same rate as last couple of years, but at maybe like a 10 to 15% range of what we've seen in the last couple of years.
Yeah. I think again, without giving any specific guidance, I think we will continue to drive for growth in all our businesses wherever we can. And as these businesses continue to generate cash, we will keep redeploying these cash that's accumulating into organic as well as inorganic growth. So I think we will see good organic growth. I don't want to give a specific number there, but it should be north of what you just spoke about.
And which is the business where you feel that the margin expansion is going to drive the expansion for the broader group right now? You mentioned that you're expecting in a few of these subsegments, but where are you expecting the biggest chunk to actually come from?
I think we should see good margin expansion in our gaming business overall with Kiddopia and WCC as well as Animal Jam. So I think these products should continue to drive fairly good margin expansion in FY24. We also expect Sportskeeda to do well in terms of margins. So yeah, I think leaving aside our Northern Esports business where we are not projecting large margin expansion, I think other businesses all will be seeing an upward tick on margins.
Sounds good. Thanks a lot, and all the best for the coming year.
Thank you.
Thank you. We have our next question from the line of Rahil Shah, an individual investor. Please go ahead.
Hi, good morning. Am I audible?
Sure.
Yes, sir. So I understand you're not giving any guidance on the EBITDA margins, but my question is a little more far ahead in the future. So I wanted to ask, have you envisioned a number, a potential or steady state EBITDA margins when your investment in new business verticals reduce and these businesses stabilize? So have you targeted any number, or if not targeted, can you just share with us any number which is you're confident is possible?
Yeah, sure. Sudhir, you want to take this one?
Yeah, sure. Right. Just so I can understand what you were saying, you asking for each of the businesses or overall?
No, overall. So, you are in a process of scaling up, you're investing a lot in your business verticals, correct? So I'm just asking, when you're done with this and when this business is stabilized, what kind of potential of steady state EBITDA margins you are confident that you will be able to achieve?
Sure. So, I think one is each of our segments, if you look at it, right now we are very much in very fast growth phase. So there's a lot of investment which is happening in the current year, in the previous year, as you've seen. And we do expect that phase to continue for a little bit. So I think when we say what are the steady state EBITDA numbers, we need to look a little further in the future than just 6 months or a year or 2 years even then. If you look at segment by segment, if you start with esports, I think definitely on that you will see similar kind of margin structures to what we have today for the near future, because that opportunity is probably the largest in terms of absolute growth numbers currently. Down the road, we do expect it will be, especially as the media properties kick in and the IPs get much higher value, that should be a very highly profitable segment as well, in line with what you would see in the media world. So I'd prefer you to sort of look at steady state EBITDA margins there. On the gaming side, we definitely see already about a 20% kind of margin structure in the businesses. And that number will expand in the near future. And longer term steady state, I mean, if I have to guess, I'd probably go around a 30% kind of a number. But again, it might take a bit more time and investment before we get there. AdTech is a different kind of business. That's more of a services business. And that current numbers are closer to 9 or 10% as you have seen, which will expand a bit, but not hugely as long as it stays focused on services. There are some product possibilities in that as well, which if those come through, then that increases the margin significantly over time. But at this point, we don't have to speak on that. Sorry, I hope that answers.
Okay, yeah, that's helpful. And another would be, why have our profit margins dropped significantly in Q4 compared to Q3? So I'm just trying to understand, is it because of like the seasonality factor, or what happened in Q4? And when do you expect it to revise?
I think I was just actually looking more at a broader picture for the year rather than because there are seasonal variations as well, business specific ones as well, which I think we called out at the different business segments rather than giving a better answer on this. So,
yeah, but just to add to that, our EBITDA margin for Q3 was 9.7%, which came at 9.6% in Q4. Given Q3 is a high margin business for many of our products, because sports data, for example, in the US realizes very high ECPM during this period, and similarly to some of the other businesses, Q3 is a high seasonal business quarter. I think we've done pretty well with the margin actually in Q4, 9.6%. If you compare it to the previous year, also we improved. It was 8.5% in Q4 of FY22. Whereas it's 9.6% in Q4 of FY23.
Okay, sir. All the best. Thank you.
Thank you. We have our next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hi, Rahul.
Hi. I hope I'm audible. Thanks for the opportunity again. Just one more incremental input on the AdTech business, specifically that we are more targeting this in the US market. So how you're seeing that market shaping up? We also saw a client impact. So how you see in light of relatively weakening macro trend in that market, and of course we have a very strong client addition matrix. So how it should balance out during this year in your view?
Rahul, we see that the services that DataWorks offers, and also backed by some of the new products they've launched. They launched a platform called MediaWorks, and they've also launched a product called Visible. We think there's a lot of value proposition for clients, and because DataWorks operates much of its team and operations from India, there's a lot of arbitrage saving that they can offer to the clients, and besides better results. So I think the weakening markets in the US should not hurt DataWorks much, because clients will look to optimize costs, and actually DataWorks may benefit from that. New client signing up has been going on at a very good rate. There's a lot of efforts that the team is doing there. So we're very optimistic about this business into FY24. We also see some very interesting bolt-on opportunities there, which can actually enhance margins by acquiring connecting entities in the US and Europe, which we are currently looking at. So I think overall we can see good growth, good margins in this business, and the new products that we have launched will also add value to that over a period of time.
Right, right. And you did this transaction of Pro Football. I think it's a fantastic transaction given the large opportunity. And I was looking at some of the peers which are much, much larger than what this company it has achieved. Of course, this is a very young company. So, if you could give more input in terms of what are the scalability opportunity here, is there any synergy to existing SK business? And also, is there any meaningful seasonality in terms of the way they recognize their revenue?
Yeah, sure. So I think, of course, NFL season probably happens in Q2, Q3. So Q1, for example, is the lowest season for Pro Football Network. But the team at Sportskeeda has a lot of ideas, a lot of synergies actually with Pro Football Network. So even in the lean season, we've actually seen significant uptick in some of the KPIs of Pro Football Network since we've kind of acquired them. So it's probably a small transaction within our network, but we are very excited about this opportunity at this point of time.
Nitish, if I may just add a couple of points there.
Yeah.
So, Ram, I think I want to emphasize that Pro Football is about American football, obviously, which is what we in India sometimes call rugby, but American football, and that's actually the largest sport in the world. Not just in the US or not just any market, larger than soccer, football, or larger than cricket. And PFN is a unique property in they've built something very interesting, and they're growing very rapidly, obviously. Seasonality-wise, the American football season lasts broadly corresponding to Q2 and Q3 of our year. So for us, we've seen this quarter, Q1, as an opportunity to sort of build a lot of, build further on the product side there and look at the synergy between Sportskeeda and then this garage. And Q2, Q3 is what will actually show the results, we hope, in that. But we do expect this to be a significant driver of value for Sportskeeda overall in the coming years.
Right. Thanks for that additional color. Just a little bit more curious about the opportunity size, because when I see this space, I see that there is one or two players which are significantly larger than what we are, and of course they are very old business that way. And there are a lot of sites which are dedicated to particular league or team. And that is also a huge market. So is there something that we could do to consolidate this space? Because otherwise, I think there's a lot of loyalty-led volume or content consumption that happens in this market for us to scale to a meaningful level. Or you think independent entity covering the entire sport is what could trend in the future?